And I think the number one secret to doing it is just to start doing it. Yeah, which, is often the case, right? But sometimes you could build it up a little too much in your head, but if that's where you want to be and that's, the type of people that you think your company can serve, then you just got to start reaching out.
Hey, welcome to another episode of multiple podcasts going on all at once because we have such an amazing person here who we're going to be talking with. And actually, this time we're doing a reverse role. He's going to be interviewing me, but you can also check out the podcast that we just recorded. We're recording on Build It to Billions podcast, Capital Gains Tax Solutions podcast, and Expert CRE Secrets podcast. And today, we're flipping the mic around to have Jake Domina interview me, particularly on Capital Gains Tax Solutions and the Deferred Sales Trust, and understanding what the strategy is, who can be a good fit for, and also just talk about some challenges because guess what? He's from a state originally from Illinois that's a high tax state, and he's working with titans of real estate that have large exits and are subject to huge capital gains taxes. Please welcome to the shows with me, Jake Domina. Jake, how we doing?
Doing really good. Thanks for having me, Brett.
Absolutely. Passing the mic to you. You're up, brother. So I'm switching the roles right here.
Well, this is exciting. Yeah. I'm looking forward to it. It's fun. I talk with Brett a lot, usually at basketball or something Friday mornings. And I am always very curious and asking questions. So it's like, hey, why don't we get together and ask me these questions on air? So I appreciate this. We work with, DLP Capital. We're a $5.5 billion private equity fund, real estate focused. Work with a lot of really large developers and investors who have issues or, tax issues that Brett could certainly help. So I'll dive right in on that. And I'll say, first of all, for one, maybe for my benefit, at least for people who aren't overly familiar with your particular strategy, could you just give me a quick overview?
Yeah. So most people struggle with capital gains tax when they go to sell multi-million-dollar exits, right? And it's somewhere between 25 to 50%. So it's always defining the problem of the proceeds are going to be crushed, depending on depreciation recapture from what state then, depending on what they're selling. And so we use something called a deferred sales trust to solve that problem and be able to defer that tax and invest and also solve a couple other problems as well. There's the tax problem, which is just the number piece, but there's also the time and flexibility with the capital to invest into things that make sense for them at the time of their lifestyle and or just the timing of the markets. And so the neat part of the deferred sales trust is it's solving multiple problems and providing multiple solutions. So it's not just a problem solver, but it's also a wealth creation plan or building block to help you invest into things like DLP Capital or other investments.
Yeah, that's great. So kind of dive into that because two of the biggest challenges with capital gains tax solutions is both the timing and the complexity. So can you speak to kind of both of those with the DST versus other options?
Absolutely. So the foundation of the deferred sales trust is a tax code called IRC 453, which is known as an installment sale. Okay. And installment sale kind of reporting is a good way to think about it versus IRC 1031 exchange, right? Which has the biggest challenge is the timing piece, right? So as soon as you can separate those two in your mind, the easier this can get. Especially because there's another thing called another DST. It's called a Delaware Statutory Trust, which is just another form of a 1031 exchange, which is still in that timing piece that makes it very restrictive for when you can do deals, how you can do deals. And so let's start there, right? Since we're IRC 453, we have no timing restrictions. We have no like-kind replacement requirement. We have no 45-day 180. We call it the shotgun wedding. Also, in a traditional 1031 exchange or Delaware Statutory Trust, you have to trade investment real estate for investment real estate, basically, right? It's the like-kind rule. Well, with the deferred sales trust, we have none of that. So we can go right into passive, Reg D funds. We can also go into the stock market. We can also go into cryptocurrency. We can also go back into other deals with clients. And so it's very flexible for that. But the biggest piece we found is connecting this mindset of tax flow, cash flow, and debt flow. And in fact, we were pretty spoiled, Jake, if you think about it, for the last, before the last year and a half, 5-6 years prior to that, rates were so low. Debt was relatively easy to obtain, and it led to a very high appreciation in a lot of real estate assets. But now we've seen that debt basically double, and people are now with rate caps that are expiring, and their debt flow is out of whack. Even if their operations are doing great, and even though insurance is a little bit higher now and some challenges there, but the debt has poisoned the deal. And so what you want to do, and what's unique about the deferred sales trust, is it enables you to exit and not have to worry about the debt flow because you can pay off all of your debt. You can be debt free. And a 1031 exchange, you've got to replace equal or greater value, which means equal or greater debt as well. And that becomes a huge challenge if you're trading at, say, a 3.5% cap rate, or either that could be the cap rate too, but the interest rate, but the actual debt, let's say it's at 6.5, 7. Now it makes the whole deal not make any sense. And so it stagnates deals. So the deferred sales trust is really unique in that we can exit, we can pay off all of the debt. It's the first piece, right? Of course, we can defer the capital gains tax. But then the best piece for our clients is they can go into groups that are doing double-digit returns, such as DLP Capital, and be able to increase their ROE, right? Which does what? Well, for a lot of people, they want cash flow right now, right? Cash flow that frees up their time, that diversifies their income streams, and provides a stable, consistent amount of revenue for them to live and do whatever they want to do.
That's great. And that's really something I didn't even realize, honestly, but you talk about the time and complexity, but also just in the current environment we're at when you're exiting loans that were much more advantageous interest rate wise into now. So that's tremendous.
Yeah. So on that point, timing and complexity, I think sometimes we forget because we're so used to the 1031 exchange and our CPA telling us this is the only way to go, that it's really complex and it's actually very restrictive. And so it's like you can choose your complexity, you can choose your restriction, right? On the deferred sales trust is something that's new. Your CPA maybe hasn't heard about it, probably hasn't, at least hasn't done it before.
Yeah.
They get it confused with the Delaware statutory trust. So definitely is some new complexity and some new ways to do things. But the old way, like we call that blockbuster, it's like choose your heart, right? Do you want to have to force yourself into a property that you may or may not want to own, especially in places like California or Illinois or New York or New Jersey, where they've become honestly not great places to do business in, right? Not great places to own real estate because it feels like at times the local authorities are making it more and more restrictive and challenging to do business. And so enter the deferred sales trust. It truly allows you to exit those highly appreciated assets, defer that capital gains tax, and then be able to invest into things at your own time. You can dollar cost average, you can be out of debt. You can also eliminate estate tax for the ultra high net worth individuals who are not wanting to necessarily pay huge life insurance policies or try to gift it away to all their kids, which can take a long time, or necessarily have to give it away to charity. And so understanding that each individual plan, right, wealth plan, needs to have a tax flow mindset to it. Otherwise, you get stuck in a situation where you may not want to be in.
Yeah. No, that's really great. And especially, I'm very interested in the estate, piece of it and how that adds value to people in that situation.
Yeah, let's break it down, right? So basically, here's the challenge that people are facing right now. In fact, there's a bigger picture. There's $84 trillion that's estimated to pass from the baby boomers in the next 20 years to the next generations. It's known as the largest wealth transfer in the history of the planet. And this is the challenge because they own 50% of all of America owns commercial real estate, high-end primary homes, and or private equity businesses. These are illiquid assets that are highly appreciated. And in fact, there's 10,000 baby boomers every day turning 65. As well, there's about 77 million in the U.S. alone. And so you look at just how staggering that is and the opportunity it also creates for groups like a DLP Capital to be able to fund opportunities is if it's just helping some of those folks exit those assets, defer that capital gains tax, but also eliminate that estate tax. So the estate tax essentially is 12 million married, 6 million single. Coming up in 2026 are the exemptions. Right now it's about 26 with inflation for a married couple and maybe 14, 13 or so for a single person. But those are set to expire. So unless Congress and the lawmakers change that, it's going to likely be a half. And so the question is, upon death, and this is the thing that I think a lot of people sometimes miss or overlook, a stepped-up basis doesn't solve this. A stepped-up basis on a 1031 exchange, you allowed to maintain a stepped-up basis, but upon your death, if your valuation of your portfolio, let's just say it's $112 billion, to keep it really simple.
Yeah.
And you're married, okay? Well, upon your death, if all 112 million is inside of that taxable estate, yes, you get a stepped-up basis for capital gains tax purposes for the children do at least. But guess what? That 12 million is exempt, but the other 100 million is subject to a 40% death tax. And that's crushing, right? That's $40 million that the kids have to either cash out, refi, have to have a big life insurance policy, or sell everything. In fact, if you've seen the show Yellowstone, you got Kevin Costner, he's got this $200 million piece of land, And his daughter Beth is telling him, "Hey, Dad, you got to sell it while you're alive, because if you don't, and everyone's trying to kill Kevin again,
Yeah.
basically, then they're going to take all the land anyways, because the death tax is going to kick in and we can't afford it." And so he's stuck in between legacy, right? He's stuck in between the government, basically taking the property through the death tax. And so all along we're on the sideline. I'm watching the show with my wife. I'm like, "Hey, Kevin, I can help you. One day, no charity, no life insurance, no gifting." And it's remarkable, right? The deferred sales trust can do that. It's super efficient, but right, there is some complexity. And we can dive into that as well if you want to kind of ask questions on that.
Yeah. So I think, and that's one thing I want to dig deeper in, because it's, 1031s in all of those, they're complex for titans of the industry, much less, average titan in the industry. You may have a much lower capital tax, gain that you have to exit, and it's just as important, if not more important. So, the limitations on 1031s and the structuring and timing is very difficult. So what are the limitations on the DST strategy?
Yeah, so there's a couple things. You need to have a third party unrelated trustee. And this is, there's basically kind of three major objections, and we'll cover that first one to start. By the way, that's our company, Capital Gains Tax Solutions. We can serve as a deferred sales trust trustee. We work with the creator of the structures, the tax attorney, by the way, and CPA. So he has both sides of tax flow, mindset and actual expertise. Thousands of closes, billions and billions and billions of assets over the years, close to 30 years. Okay. But more than all of that, over 25 no change audits, state and federal. So the legal track record is literally perfect, right? So it's all been established there, but it does take a third party unrelated trustee that you are selling the asset to, essentially a trust, and this trustee is overseeing it. So that you have to become comfortable with, right?
Yeah.
Versus it just being in the family or somebody that had worked for you or that you know. But if you think about it, it's not necessarily that much different than a third-party qualified intermediary.
Sure.
But there's 5,000 qualified intermediaries out there, and these are happening so often that we've become accustomed that we are actually giving up control when we send our funds to a call. Yeah, and it's just like the frog in the water that's warmed up. Since we've been in it so long, we don't necessarily notice that we're giving that up. Now, albeit it is 45 days to 180 days, so it is a short period of time. But that is something to understand. Also, if you work with an IRA or 401k, there's third-party administrators. There's different pieces there. So the deferred sales trust, for sure, you're going to have to give up some control. Now, we call it indirect control because you are the creditor. So what's happening is you're selling the asset to the trust in exchange for a promissory note. Yeah. So we would know that as seller carryback, right, Jake? If we owned a $100 million apartment complex and we wanted to sell it to somebody, and imagine they're free and clear, and he goes, "Look, I don't have $100 million, and the banks aren't financing right now. Could I put down $30 million and you carry back $70 million? In that scenario, that's an installment sale. And on that $70 million that Jake hasn't received, it's in a deferral state. Now, the other $30 million would be taxed. Now, some of the reasons why you wouldn't do that real quick would be you're basically banking on somebody on one property, one asset that's illiquid, that the person may or may not perform on, and your $70 million is tied up. So you're not likely to do that deal. Into the deferred sales trust, we go, "Look, Mr. Buyer, look, we appreciate the $30 million, but go get the financing somewhere else on the other 70. We want to be cashed out at closing, but we will ask you to cooperate with the deferred sales trust, and that you're going to sell the asset first to the trust for $100 million, but you're going to do 100% seller carryback, okay, with the trust. Turn around, the trust is going to sell it to the buyer for $100 million, okay? So the trust bought and sold for the same price, no gain. Okay. The buyer takes title, he's gone, but the cash is liquid. This is the coolest part. Yeah. You can use it, like as a real estate entrepreneur that you and I are, right? And the way that we work and the way that we work with the people that we work with, we want to be able to go into things that make sense for us when they make sense. We want to be able to control outcomes in the sense of having powder dry. Yeah. So the deferred sales trust takes a third-party trustee. That's the first thing. It's an installment sale. It's the second thing. The next thing would be understanding that nothing moves without your approval or your signature, right? Funds are typically held like a Charles Schwab. We typically have third-party financial advisors, certified financial planners, some of the best in the whole country to manage the capital. Oftentimes, we're also working with their trusted advisors that are exiting. So the trustee, in the sense that you say, well, wow, am I giving up all of this control, all to the trustee? No, we have controls in place to help keep everything transparent. In fact, there's a third-party tax attorney who represents you. There's a third-party tax preparer that does the tax returns for the trust. There's, funds are held like the Charles Schwab, another third-party group, typically a third-party financial advisor. And so these are all these groups that are not working for each other, but with each other,
Yeah.
that create controls, transparency, accountability to help ease some of that initial thought of, wow, I've been an owner my whole life. You're
Right.
saying I'm giving up some control. Well, yes, but here's the other part of that too. Remember, if you sold in Taxifornia, for example, you're looking at a minimum of 37%, probably 50% of the gain being wiped out. So guess what? When that 100 million goes into the trust and you have a zero basis, well, how much of that is really your money? About 60%, let's just say.
Yeah.
The other 40% is the government. So the government's also entrusting the process in one sense. This is part of why the legal framework to make this work. And so those are some of the complexities. Obviously, if you have any questions there, we can go to the other two objections here in a minute too.
Yeah, no, I think that's great. And you touched on a lot of them, just how, your company in particular is putting people's minds at ease, in this strategy, which if they ask their advisors and stuff, they probably don't really know a lot of detail around it. So how do you, combat that to help them understand, and their advisors, honestly, how you as a company are a good fiduciary in that?
It's the most important question. In fact, our Dream 100 strategy is to work with the top CPAs and tax attorneys in the country to educate them through NDAs, how we do what we do so we can strategically align to speed up the know, like, and trust, right? We do work directly because a lot of clients find us, online or through speaking engagements or through our book. And then they come directly and they are bringing in that trusted advisor. And we encourage them to do that. We don't want to say, fire that advisor. We actually want them to come alongside with them during the due diligence. And part of what we offer is a no cost, no obligation due diligence where the CPA, the real estate professional they work with, the financial advisor, whoever, they can come in, they can sign the NDA. And now we're going to open up our playbook and show them step by step on how this works, our success stories, and, talk with our clients. And we literally break it down. I'll give you a couple examples of this to kind of bring it to life. One of my first calls as a Marcus and Millichap when I started out was selling real estate, multifamily real estate. And this is in 2006. And when I started, and then the market basically crashed, 07, 08, and everything kind of hit the fan. And I went to making a little bit of money to like nothing overnight. So I was like in kind of oh my gosh mode, like what am I going to do? New baby at home. My wife and I, we had to move in with my brother in a small condo. I'm working side hustles at Cheesecake Factory to keep the lights on, but I'm continuing to cold call people. And I got approached, or I got a chance to learn about the deferred sales trust. But like most of us, we said, this seems like it's too good to be true. We would have known about it. We felt like we were the Navy SEALs of investment real estate. We're like, we knew 1031s like the back of our hand. But all of a sudden, there's something new that could have actually changed the outcome for our clients. Now, this is 2009 at this point, so it's kind of like too late from that first crash. But this began the process of actually vetting the strategy myself. But now I'm just a layman commercial real estate broker at the time, right? I feel like I still kind of am, but I've learned about this strategy that helps people. But I started to approach people that are worth 30 million, 50 million, 100 million, billionaires with the strategy. And at first, they kind of said, Brett, aren't you just a commercial real estate broker? My CPA hasn't heard about this. I go, well, what'd you bring to the call? Right. Now, he wasn't just coming on with me. I was actually bringing him on with my business partner, Todd, to go through the strategy in detail. And now Todd is a brain surgeon. He's a CPA and a tax. So here's the key. You want the CPA to talk with the CPA. That's one of the biggest things. And when we brought them on, Todd, time after time, what I would say helped them become a believer in what we were doing. The legal track record, how it worked, why it worked, right? The essence of what it's about. And as I saw and observed and really understood the essence of it, they all started joining us, right? And it started to build up momentum. Two stories in particular. One gentleman, his name was Ron, and Ron was selling a $30 million industrial property in Napa, California. And I grew up in Northern California most of my life, and we would visit there and have a little bit of wine here and there. Well, he had like wineries, and this guy had an industrial property. He was, probably worth $500 million, but he knew it. He's selling a $30 million property. I call Ron and say, Ron, they do it in 1031 exchange. He goes, no way. These deals don't make sense right now. Okay. Well, what are you going to do with the tax? Well, I'm just going to pay it. Okay. Well, what if there's a way you didn't have to do a 1031 exchange and you can still defer the tax? He goes, what are you talking about? I said, well, it's called a deferred sales trust. And the first thing he says, it sounds like it's too good to be true. I go, okay, Ron, I hear you. But would you keep an open mind? Would you come on a call? He goes, look, I will come on a call, but you have to convince Lou Weller. Now, Lou was a top tax attorney with Deloitte. You can convince Lou, I will do the deal.
Yeah.
Okay, cool. Sounds good. Bring Lou on. Lou comes on. Lou signs the NDA. Lou's nationally known with Deloitte, one of the top attorneys in the country. And guess what? Lou is super skeptical and cautious.
Yeah.
Now, Lou took a while. It took like a 6-month due diligence. This deal was a long escrow. Lou comes back, fast forward, he goes, it works. He writes a legal opinion. He says, I think it works. Here's my private legal opinion for you, Ron. I call Ron up. Ron, great. You want to do the deal? He goes, no. I go, what do you mean, Ron? Like, you just told me you would do the deal. He goes, no, you need to go do, 20, 30 deals, Brett, then come back to me. Like, this is like your first big deal. And I thought this was going to be payday. I was going to be able to like do all these things. But my point of sharing that too is like, it's not a one size fits all, just unlock the key, even if you have the trusted advisor. It does take time and energy to understand this. Have those advisors. Nowadays, we're closing deals because we have people that will vet it. They have the track record. We have all the pieces in place, and people close more. I'm still a little bit bummed. Ron, I hope you call me again. You're selling that other asset. Hopefully that answers some of the questions there on the legal complexity part.
No, that's awesome. Thank you very much. And I love the specific examples because it helps people, really put themselves in those shoes. So no, that's great. One thing I wonder too is obviously we deal with a lot of active real estate investors as well as passive, but what about, versus active real estate investors versus just passive investors who are just investing, other capital gains that they made that have nothing to do with real estate? How does that work?
Great question. So the deferred sales trust is great because it works for multiple asset types, right? Really any asset of any kind. It works for cryptocurrency. We've done $13.5 million of Bitcoin and Ethereum exits before the last crash. And we just did an NFT deal last week. It works for business sales. We did $11 million for a client, Nick, on an $8 million business sale in Colorado. It works for mobile home parks. It works for multifamily. It works for primary homes. We did a luxury primary home in Palo Alto for $8 million. It works for stock, public or private. In fact, I'm having, in my book, Building a Capital Gains Exit Plan, we have Kevin Hinton from Shark Tank in the book. And part of why he's in the book is because when I interviewed him on my podcast, he goes, Brett, you're telling me you can defer capital gains tax on the sale of public stock? And the answer is yes, you can. And he didn't even know that. He's one of the best entrepreneurial billionaires in the world, right? And so, yes, whether you're active or passive, whether you're selling it for yourself or you're selling other assets, you can defer the capital gains tax to the installment sale. And then once the funds are in the trust, they can go into active or passive. In other words, it doesn't have to stay in any kind of like kind, right? It can be from crypto into like a DLP capital fund. It can be from like stock into a DLP capital fund, a primary home. And then vice versa. You can be exiting real estate. Maybe you want to go into cryptocurrency and diversify and do that. One of the best cryptocurrency deals we have is for a client. She bought Bitcoin for $50,000 and it went to $50 million. And she never sold until she met us. And part of it is because she lived in California and she didn't want to move to Puerto Rico. And she's like, Brett, I have about a $5 million exit is what I want to start with your company. I have about $1.85 million of capital gains tax if I don't use your strategy. Can you help me sell and defer? And so the answer is yes. So we sold at $54,000 a coin, exited the $5 million into the trust. And then she's forwarded the $5 million for startup capital for her own entrepreneurial journey. So it doesn't have to be just passive. You can still be that entrepreneur. In fact, this is the best kept secret with this is you can partner with the trust and the trust itself can be the silent joint venture partner and bring the capital. But it's kind of like you borrowed from yourself, but you technically borrow because borrowing is a taxable event. It's a true joint venture partner. So she's doing a Khan Academy type of style online environment for children to learn around the world and spread education. That's her freedom that she's impacting the world with. And it started with Bitcoin. It started with 50,000 of Bitcoin that went to 50 million. And it started with a strategy that allows us to unlock that capital and make a big impact in the world.
That's phenomenal. I think of a lot of people who maybe have built some wealth through real estate and they want to do other things, right? And it could be other strategies could limit them to having to stick with, real estate. So that really allows people to change and multiply the impact they can have in different ways when they find that that's where they're best suited. So I really like that piece of it.
Yeah, the way we say is we exist to unlock capital gains to multiply freedom and impact. And again, back to the $84 trillion challenge of the baby boomers in the next 15 to 17 years now at this point. It's transferring to us, right? To our generation, right? It's transferring, it's happening. It's the largest wealth transfer in the history of the planet. So just think about how staggering that is. Our national debt's about 34 trillion, I think, at this point. It's out of control. We've got 84 trillion, and we're never going to solve the 34 trillion by taxing. However you think about it, that's part of the gap. It's like this, imagine a gold mine or oil that's stuck in a place, 84 trillion, that's just, it's stuck under the ground if you think about it, right? And if there's a way to unlock the freedom and flexibility and the flow of that capital, to create more commerce, right? Which is, by the way, why the government allows these type of strategies, because what it ultimately does is it creates more jobs. It actually creates higher property tax. Back to the Paul Alonso $8 million sale. Well, he had a very low basis. Now it's a new property tax. That's good for California, right? Now the money itself gets invested into other things that grows the economy, right? Which creates more jobs, which creates more tax revenue. So the key is the tax flow of this. And if we can unlock this 84 trillion in a very tax efficient way that pours into the economy, that builds housing, we believe we can solve some major crises in America, because tax is a big part of our life. It's one of the biggest expenses we'll ever have. And so that's our mission for the next, for however long we're able to do this, but at least the next 15 to 20 years on this 84 trillion to make that impact and hopefully change the world in a big way.
That's awesome. Yeah. And I could speak, personally from knowing Brett and having clients that we referred over to, and just the amount of stress and that this can add to people's life to really figure this out, particularly as you're getting up in age and you're trying to have a strategy there. But just throughout any point in life, the amount of stress that this can clear, and it's beyond the financial gain. It's the smile, and it's the way they're much happier afterwards, and the thanking me for just introducing them to Brett. So I imagine, what, you kind of mentioned it there, but what is your number one, like what you are adding to this? What is your mission that you're helping the world with and people with by doing this?
Yeah. Every family has a unique story. Right. And I'll just talk about Nick and Jeannie Katzer for a second. Right. And in fact, they were at the DLP conference here in Sawgrass, Palm Beach, Florida, just about a year ago, 6 months ago. And to see the relief of not having, they're in their 70s, to own and manage real estate. Now they're in Colorado, and Colorado has become more and more challenging to do business in over the last couple of years, and to be able to maintain their legacy. So Nick grew up, and his grandfather taught him how to basically be an entrepreneur. And he also taught him how to invest into real estate. And he took that, he's built that to probably $30-40 million worth of real estate over his, like, an American dream. And likewise, his wife, Jeannie, grew up in a business with the family business goes back 50 years. So she was there in the beginning of this business that was growing. And now they're entrusted with the wealth. They built some of the wealth, and they were entrusted with some of the wealth. And now they're getting to the point where they're going, how do we maintain the legacy, and how do we be great stewards with what has been given to us and things that we've earned over the years, and to be able to come in alongside and literally be the, like, I don't want to say lifeline's the right word, but the key cornerstone solution to let them kind of retire, but also be able to entrust the capital to a group like DLP Capital. In fact, for them, the majority of their capital from the trust is with DLP. Yeah. And so what I loved about working with you guys is I call it a three-legged stool for the deferred sales trust. You have the tax attorney, legal track record, lifetime audit defense. You have the trustee you've got to be able to trust and be able to work well with. And then you got to have the place where the funds are going to be invested. And if all three of these are standing strong and we can entrust the durable returns, he's over the moon. In fact, he recorded an entire episode at the DLP conference where they share their story. You can go to my YouTube channel, Capital Gains Tax Research, to hear this. But that impact and that freedom and that flexibility, that means the world to me and to them. I get to become a part of their family. I get to become a part of their trusted advisor. I kind of get to be part of their inner circle. And so in one way, I thank the IRS and the tax man because of that pain point. We're able to solve a big problem, and we become alongside of them. And the next part would be the next generation. Being that I just turned 40, he's also planning for the future with how and where the funds will be invested upon their passing, right? And so having a structure in place that, and a team in place that helps to continue to guide that to the next generation is a part of being great stewards. Now, sometimes it's always for all the kids, but sometimes it's having those trusted advisors alongside of the kids. So some of the sons are our age, right? Yeah. And so we're becoming close as well, and they have their careers and their things. And so if you start thinking about that, like, what's the dream team for my current legacy, but also my future legacy? So those are just some of the things that are just really, and then we can go down every single client story, but those are just a few that really, that one really sticks out for me.
Yeah, no, that's tremendous. It's tremendous impact. And I can't imagine the ease that they feel, at that stage, especially knowing that you're talking with their kid and you get to know them, and they can, move on in a much more peaceful, manner. So that's phenomenal. I guess final question I think that I have is, as we're talking about this amazing impact that you're able to make, how can people who are, you know, like myself or any others who are listening, who maybe have enough to be dangerous or semi-understand, what is the quick kind of pitch they could give? What is the quick summary that they would tell someone who is exiting a capital gains? You have to reach out to Brett and talk with them on this, and how do they do that, and what do they say to us?
Yeah, I think a couple questions you would ask is, hey, where are you at right now? Where are you trying to go? So it's always starting kind of broad and bigger picture, right? With your wealth, with your time, with your legacy. And then it's opening up opportunities for awareness. Are you aware of the death tax and the exemption amounts that they cut in 2026? Are you aware of what the capital gains tax rates actually are for your state and where you're at? And have you done a tax flow analysis as well as a return on equity analysis? We did a deal for Warren and Catherine Strand for $2.5 million out of Sacramento. Our team, we sold the property for them, deferred the tax. Their NOI was $120,000, and I did some quick math with them. Well, with the deferred sales trust and investment with DLP Capital, for example, we can get to about 190 pretty conservatively. And so we increased their cash flow and decreased all of their time and energy with the toilets, trash, and termites, right? And so that was incredible, just those numbers. So I think it's a numbers as well as it's the impact and the freedom that we can provide people as you start to dig in a little bit more micro. And so just having those conversations, understanding really what they're trying to achieve, where they're trying to go, and then say, if there was a way to eliminate the need for the 1031 exchange, because I think most of you are talking about own real estate, defer the capital gains tax and increase your cash flow, would you be open to an analysis for that? And I think 95% of people say absolutely be open to that, right? And then you just connect with us at capitalgainstaxsolutions.com. Yeah, you get our book on Amazon, Building a Capital Gains Tax Exit Plan, and then you can also that's really it. Come to one of the DLP conferences or any other places that we're at, and we'd love to just talk with you, get to know you, and see if we can be a good fit.
Well, that's great. And this book is a great value add to send to your client, to get them thinking about it. So I love that. Well, awesome. I know I'm excited. I know a lot more about this, and I'm excited to help the people that I work with day to day. So I think this is great, and I appreciate your time.
Fantastic. Well, thank you so much, Jake, for interviewing me. And thank all of our listeners for listening to the episode of the Capital Gains Tax Solutions podcast. Also streaming on Build It to Billions, so you can give it all away podcast. And the Expert CRE Supervised. I know it's a lot of podcasts, but we're trying to spread the message as best we can to each individual segment of our audience that are listening. Please take action. Please share with someone who can encouragement to. Pick up the book, Building a Capital Gains Tax Exit Plan, and go to capitalgainstaxsolutions.com if you want to learn more there. The last thing we'll leave here, I know this is a lot, we have the best 1031 exit plan we just released on experttaxsecrets.com. And that gives you the regular 1031 exchange as well as the deferred sales trust for our backup plan. Sometimes it's a combination of both, but we have a saying around that friends will let friends 1031 exchange without a deferred sales trust backup plan. Don't get caught with an exchange company that doesn't give you both options and where you're scrambling to either have to force to buy a deal or you're just going to pay the tax. Get with us soon, right now. Use all of your 1031 exchange needs through us, and we will help you have hopefully a really peaceful and great outcome. Thanks everyone for listening, watching. Please subscribe. Please give us a like. We appreciate you, and we'll talk again real soon.